Hello and welcome back to part 2 of this financial accounting preparing financial statements mock exam walkthrough. So this is part 2 as I've just said, and we'll be covering task 4 through to 6. So this is carrying on from part 1, so hopefully you have watched that one first, and we'll now run through the remaining exam. So let's get into it. So task 4 is worth 24 marks and is about producing financial statements for sole trades and partnerships. This task contains parts A and B. Part A then, identify whether the following statements are true or false, and it's worth 4 marks. So in partnership accounting, the current accounts show the long-term investment in the partnership. Well, that one would be false. It is the capital account which shows long-term investing in the partnership. The current account is there to accumulate everything that's involved within the appropriation account and any other adjustments that need to be made. So that one would be false. Next one then, the finance by section of a partnership statement of financial position includes the balances of the partner's capital accounts and current accounts. Well, that one is true. Not a great deal to add on that one. It shows both capital and current account, so it would be true. Next one then, in partnership final accounts, the appropriation account starts with the gross profit figure. Well, that one would be false. We start with the net profit figure. The gross profit, you haven't actually taken off your expenses yet, so that definitely don't want to be starting with that. We would be starting with the net profit figure. And then the last statement, in a partner's current account, interest on capital is debited and interest on drawings is credited to the account. Well, that would actually be the opposite way around. So interest on capital is credited to the partner's current account and interest on drawings is debited. So that would also be false. Anything which increases the amount owed to the partner is a credit within the current account. Anything that decreases the amount owed to the partner would be a debit in the current account. Part 2 then, identify which one of the following describes net assets. So straight away, hopefully we know that net assets is all your assets minus all your liabilities. So let's see which one fits best. So total assets less current liabilities. So that doesn't take into account non-current liabilities, so it wouldn't be that one. Current assets less current liabilities. Well, it definitely wouldn't be that one. That doesn't take into account non-current assets or non-current liabilities. We've then got non-current assets less non-current liabilities. So that statement doesn't take into account anything to do with current assets or current liabilities. So it wouldn't be that one either. So let's hope it's option 4. Otherwise, we've got a mistake within the mock. So option 4, non-current assets plus current assets less current liabilities less non-current liabilities. So that one would be correct. So that would be all our assets. So non-current plus current minus all our liabilities. So current and non-current. Fantastic. Okay, so smooth sailing so far on this question. So part 3, complete the following statement. The purpose of the statement of financial position is, and we've got some options. We've got examine the cash position of the organisation. It's definitely not that. We don't need to go through an entire statement of financial position for that. We can just look at either the bank or the cash book. We've then got ensure that debits and credits are equal, or ensure that debits equals credit. Well, that's what your trial balance is for, not the statement of financial position. You then got show how profitable the organisation is. Again, definitely wouldn't be that one because that's what your P&L is for, your profit or loss statement. So again, let's hope it's this last one. So it gives a snapshot of the organisation's assets and liabilities at a particular point in time, which is absolutely spot on. That is exactly what the statement of financial position shows. Next question then. Lucy runs a jewellery and gift shop. She is a sole trader and the year end is the 31st of March 2018. You are given her trial balance as at the 31st of March 2018. And you can see that we've got a trial balance. The statement of profit or loss has already been calculated and the profit for the year is £33,054. During the year, Lucy made personal calls on her work mobile phone. The cost of these totalled £180, including VAT. So part B then, complete the pro forma journal below to account for this. So we need to account for the fact that Lucy's made these personal calls and they've been included within her business accounts. So think about which accounts this will affect. So it's going to affect VAT, it's going to affect the mobile. So I'm expecting to see some sort of mobile expense on there. And then the last one, in terms of where this would go, because she's been taking it from the business for personal use, it would actually come from drawings. So the three accounts I would expect to see here as options would be drawings, VAT, and some sort of mobile phone expense that we can adjust for. So let's have a look what we've got. So we've got drawings, we've got mobile phone expenses, excellent, and where's VAT? There we go, right at the bottom. Okay, so we've got our three accounts. We now need to think about how it would affect each of these accounts. So we know to increase drawings, we need to debit it. So we would debit drawings for the full amount of £180. We would then credit our mobile phone expenses to reduce these down. Because these were for personal calls, we don't want to be showing the expenses as high as they currently are because they're not business related. So we need to remove those. So originally they would have been debited as it's an expense. Therefore, to remove them, to reduce the account balance down, we need to credit it. And this would be for the net amount. So that would be 150. And then the VAT on £150 would be £30. So we would credit VAT for £30. Okay, you can look at that from two sides. We can think of it purely from a VAT perspective. Originally, we would have been claiming that £30 when we shouldn't because it's not for business use. Therefore, to offset that, we would need to credit it to remove it, or even just from a really simplistic perspective of just basic double entry, our debits and credits need to match up when we're doing a journal. We can't have debits higher than our credits or credits higher than our debits. And we can see from this that we've got debits for 180 and credits for 180. So if you're ever actually having some sort of mind blank within the exam, obviously use that technique, go back to your basics. You know that double entry when you're doing a journal or just in general has to match up. Okay, next question then. Following the inputting of this journal, calculate the revised profit for the year. So we've been given the profit figure here. So we've got £33,054. Think about the effects of this journal on that profit figure. So drawings doesn't affect profit. It goes to your statement of financial position as a reduction to your capital account. Mobile phone expenses would definitely affect your profit figure as it's an expense. Now we'll come back to that in a second. Let's just see what we need to do with VAT. So again, VAT would not affect your P&L figure, your profit, because the VAT goes to your statement of financial position as either an asset if we're claiming money from HMRC, or a liability if we owe HMRC money. So the VAT and drawings wouldn't affect your P&L figure, your profit figure. It would just be this mobile phone expenses. Now, because you're reducing your expenses by £150, the effect of reducing your expense would therefore increase your profit. So it would be £33,054 plus £150, which would give you a revised profit figure of £33,204. Brilliant. And then from there, this looks like it follows on. So it says complete the capital account for the year. So if we've got to do one of these, always start out with the opening balance at the beginning of the year, which should be given usually in your trial balance. So we should have, there we go, opening capital, £24,580. So remember, go off what the trial balance says. You would expect it to be a credit. It is feasible for it to be a debit. It's just less likely. So opening capital credit, 24,580. So we'd have balance brought down, 24,580. Now the next transaction, I would actually input your profit. So profit increases the amount owed to the owner of the business, so therefore it would be a credit within the capital account. So we should have on here, let's scroll down a bit so we can see profit for the year, and it wants to be your adjusted amount that we've just worked out, so it will be 33,204. And then all we need to do now is take off our drawings. Now, we increased drawings by 180, but I am guessing that there would already be a balance in your drawings account. So let's have a look at our trial balance. We do indeed. So we have an existing balance in our drawings of 28,776. And that was before we made the adjustment. So after we made the adjustment, we've added on £180 to our existing drawings balance. So it would be 28,776 plus 180, because we've debited it for a further 180. So that means our new drawings balance, again, let's just scroll down, would be 28,956. So the last step on here would just be to close off the account by doing the balance carried down. So we do balance carried down, and it wants to be the difference between the two sides. And the difference between the two is 28,828. What's nice is with these automatic calculations at the bottom, we can see that it's balanced off right because the totals should be the same. Okay, excellent. So hopefully nothing too complex there. Let's move on to the last part of this question then. So using the figures in the trial balance, complete an extract of the statement of financial position as shown below. And it does say, note you are completing the SFP down to the net assets figure. So we're not doing the finance by section. Okay, so all this information should be within our trial balance. So let's start off at the top with the non-current assets. So what's the cost? What do we have for our cost? So our cost is 6,487 for fixtures and fittings. I can't see any other non-current assets on there, so we can enter that in. So we would have 6,487. Scroll back up, and then we can enter in our depreciation, 4,255. And from there, we can calculate the carrying amount, which would just be the cost less accumulated depreciation, which gives us a carrying amount of 2,232. We can then move on to the current assets. So we've got 4 available boxes. So we will look for 4. However, it is feasible that there isn't 4. So just bear that in mind. So let's have a look and identify them, and then we can enter them in. So we've got bank, we've got closing inventory, we've got the receivables ledger control account, and that looks to be it. So 4 available boxes, but there are only 3 options. So let's go and enter those in. So we have bank. In theory, truth be told, you do usually do these in order of liquidity, but it really doesn't matter. You don't lose any marks on this for not doing them in the order of liquidity. So trade receivables and inventory. Excellent. Right, let's enter the figures in. So we had bank 35042. Inventory 11,424. And then trade receivables, we had 14,442. We can now move on to our current liabilities. So again, let's see what we've got available to us. So current liabilities wise, we've got payables ledger control account, and we've got VAT. Can't see any accruals in there, so they would be the only 2. So let's enter those in. So we've got trade payables and VAT. So trade payables was 30,814. We'll now get our VAT figure. So our VAT figure was 3,468. However, we did make a journal entry to credit it for a further £30. So it will be 3,468 plus £30 to give us 3,498. Fantastic. We can then work out our net current assets figure, which is just our total current assets minus total current liabilities, which gives us a figure of 26,596. And then the net assets figure would be the non-current assets plus our net current assets. So add those two together, and that gives us a net assets figure of 28,828. Fantastic. Okay, hopefully nothing too challenging in that one. Let's now move on to task 5. Right then, task 5 is worth 18 marks and is about interpreting financial statements using profitability ratios. This task contains parts A through to D. Part A then, identify which two of the following are considered primary users of final accounts. So hopefully this is one that you've learned during your studies. It should be somewhere within your book, or I would expect it to be anyway. So the two out of this list, we've got existing investors, employees, lenders, customers, and government. So the two there would be existing investors and lenders. It does also include potential investors. They would also be classed as primary, and suppliers could also be classed as primary users as they have lent us money. That would be credit suppliers, our trade payables. But out of that list, it would be those two. Moving on then, so identify the accounting principle being described in each of the following definitions, and this is 4 marks, so 1 mark for each definition. Sales revenue should be recognised when goods and services have been supplied. Costs are incurred when goods and services have been received. So that, to me, looks like it's describing the accruals concept. So the accruals concept states that goods or services should be recorded when the work actually took place, not when the money was paid or received. So that would describe the accruals concept. Next one then, financial statements are produced using the assumption that an entity will remain in business for the foreseeable future. So that would describe going concern. Again, these are ones that you should have learned throughout your studies from your textbook. So hopefully this is nothing new to you. Next one, transactions and valuation methods are treated the same way from year to year or period to period. Users of accounts can therefore make more meaningful comparisons of financial performance from year to year. So it's describing some sort of comparison, consistency. So there we go, consistency. And then the last one, profits are not recognised until a sale has been completed. In addition, a cautious, anytime it mentions cautious, you probably go down the prudence concept route. So in addition, a cautious view is taken for future problems and costs of the business. They are provided for in the accounts as soon as there is a reasonable chance that such costs will be incurred in the future. Yeah, absolutely. So that perfectly describes what you would follow for the prudence concept. Not a great deal to add on those. It's one of those where you just need to learn the definitions. It's not worth a huge amount of marks, but it obviously is still worth knowing because it is something that if you carry on to level 4 as well, you will need to know there as well. Moving on then to part B, identify whether each of the following statements about profitability ratios are true or false. 3 marks, so again, 1 mark for each statement. First one then, the analysis of financial statements using ratios provides useful information when compared with previous performance or industry averages. That would be absolutely true. When it comes to ratios, it's definitely a apples to apples kind of scenario. It's absolutely no good comparing to different industries because different industries have really varying results on these. You'll have some which have really low margins, but volume will be really high, so they'll have huge revenue, and the way they have to make their money is by selling a lot. And, you will skim a small margin off that, but due to volume, you'll still make a good amount of money. So supermarkets, something like that. But other industries, a lot of the service-based industries, that won't be the case. You'll have much higher margins. Coming back to my original point, that would be true. Next one then. So an organisation's management will never use financial ratios to assess its performance. I mean, that is quite clearly false. They definitely would. Nothing more to add on that. Ratios based on historical data can always predict the future performance of an entity, so that would also be false. Although they are useful and they can be helpful when predicting future values, they definitely can't always predict future values. Turning the market is so common, even if you think about fashion or particularly technology, it's such a fast-paced environment that you cannot always go off previous performance to be able to predict future performance. So that would also be false. Onto some ratios then. So you are given the following information about an organisation. The statement of profit or loss shows the following figures. So we've got sales revenue, gross profit, and then profit or loss for the year, or net profit. The statement of financial position shows the following figures. So it's given us the non-current liabilities, current liabilities, and capital. So part C then, for 4 marks, complete the following ratios based on the information above. Show your answers to 2 decimal places. So 2 marks per ratio. So return on capital employed, the ratio for this will always be your profit or loss, so your net profit, over your capital employed. And capital employed is made up of 2 figures. It will be your non-current liabilities and your capital. So what we do is we add the 2 together. So we add your non-current liabilities to your capital, which would be 133,810. And we then take our net profit, our profit or loss for the year of 79,350, and we divide it by that capital employed figure of 133,810. And then because it's a percentage, we would multiply it by 100. And that would give us 59.30%. Remember, it wants this to 2 decimal places. So 0.30. The net profit margin, nice and straightforward, is simply your net profit. So profit or loss for the year of 79,350 divided by your sales revenue figure. So it's showing your net profit as a percentage of your sales revenue. And again, times that by 100 because it's a percentage, and that would give us 18.49%. Brilliant. When it comes to ratios, it is a case of just learning them, practicing them. They should be really straightforward. I don't think they'll throw anything in to confuse you. It is just a case of learning them. You will need, again, to learn them for level 4 if you do want to move on to level 4 after you've completed your level 3. So get them in your head now. It will make life much easier when you do then get to level 4 because you already know at least a few of them. Right, moving down then, you have already calculated the selling expenses over revenue percentage for the current year as 15.6%. The corresponding figure calculated from last year's accounts was 13.2%. Complete the following statement for 1 mark. The selling expenses over revenue percentage shows, and we need to select either an improvement or a deterioration when compared to the previous year's figures. Well, if the selling expenses over revenue percentage has gone up from the previous year, because in the previous year it's 13.2, it's now 15.6, that would be a bad thing. What we're saying is our expenses is now a higher percentage of our overall revenue figure, which is bad. Obviously, we want to keep our expenses as low as possible, and hopefully that would increase profit. So it's actually deteriorated throughout the year. Fantastic. Moving on to part D then. Identify what effect, if any, each of the following scenarios may have on the ratios stated. Each scenario is independent, and this is worth 4 marks. Scenario 1, your company has managed to negotiate a lower price with a main supplier of your inventory. This has not affected the quality of goods you receive. So think about how the inventory would affect your first one on the list here, return on capital employed. So we've already said that return on capital employed is your net profit figure over capital employed, which is made up of your capital and your non-current liabilities. Now, cheaper inventory is not going to make any difference to your capital employed. It's not going to affect your capital. It's not going to affect your non-current liabilities. It is, however, going to affect your net profit. Because obviously, if we've got a cheaper price for our inventory, that would lower our cost of sales figure. So therefore, it would actually increase our profit figure. So if we have a higher profit, that would also in turn increase our return on capital employed. So that would be increase. And then cost of sales as a percentage of revenue. Well, if our cost of sales have decreased because our inventory value is lower, we've managed to source this cheaper inventory, but our revenue stayed the same because it doesn't say that our revenue has changed, it would mean that our cost of sales as a percentage of the revenue would decrease because we'd have a lower cost of sales figure. So that would be decrease. Scenario 2 then, the wage rates of administration staff have risen in line with others in the industry. The amount or skills level of the labour has been unaffected. So we need to determine, will it have an effect on gross profit percentage and net profit percentage? So a little bit cheeky this one actually, because if you've never done costing before, I suppose I could see why this could cause a slight issue. Now, administration staff, the labour for those is not going to form part of your cost of sales figure. It would be an expense. So it would have absolutely no effect on your gross profit at all, because your gross profit is simply made up of your revenue less your cost of sales. Because they're an indirect cost, they have no effect on the actual cost of sales, which is something that you would learn more about within your actual costing units. So a little bit cheeky from AAT there. But as I said, this will not have an effect on your gross profit percentage because the wages for administration staff would come in under your gross profit, i.e. calculated as part of your expenses. So it would have no effect on your gross profit percentage. However, it would have an effect on your net profit percentage. So if you think that the expenses for these administration staff have gone up because the wages have gone up, that would have an adverse effect on our net profit percentage because it means our expenses are higher, which would mean a lower net profit. So therefore, our net profit percentage would decrease. Okay, fantastic. That does finish off task 5. A couple of tricky ones in there. Definitely some that may need a little bit of practice, or if you need to go back in the video to go back over what I've actually said for some of these, that's absolutely fine because I know a couple of them in there are a little bit complicated, so no problem if you need to do that. We'll now move on to task 6, which is our last task of this mock exam. So task 6 is worth 12 marks and is about preparing accounting records from incomplete information. This task contains parts A through to C. Ian printed a report from the accounting software system. The report suggested his closing balance of product TP2 was 368 units valued at £1 per unit. The TP2 is a small component. An inventory count revealed that Ian held 378 units valued at £1 per unit. Part A then, identify whether each of the following could have accounted for this difference, and it's worth 4 marks, so 1 mark per situation. So for these, basically what we need to do is try and work out whether for each of these situations, could it have caused the difference or would it not have caused the difference? So effectively, we're looking for something that would cause the number of units within the accounting software to be too low, or a reason why the inventory count, so the physical inventory, would be too high. So let's have a look at each situation and think which would be a possible reason and which one couldn't be. So the first one, theft of inventory by members of staff. Well, this definitely wouldn't account for the difference between the two. If there'd been a theft of inventory by staff, that would have meant that the physical inventory, there would be a lower number physically available than what was recorded on system. So that definitely wouldn't be a reason. The next one, a purchase credit note has been entered twice onto the accounting system. So that one could be a reason, because if we think about that one, if a credit note's been entered twice on system by accident, presumably, that would lower the amount within the inventory by too much because we've entered it in twice. Now, because the inventory on system is lower than the physical count, that could be a possible. The next one, a box of TP2 has been omitted from the inventory count. Well, that one, again, that definitely couldn't be a reason, because if you had omitted that from the inventory count, that would cause your inventory to be too low, as in your physical inventory. However, it's not, it's too high. So that wouldn't have caused the reason in this particular scenario. And then number 4, production had returned a number of the components unused, but this has not been recorded. Well, again, that one definitely could be a reason. So if we think about this, production have returned some of the physical inventory, but it's not yet been recorded on system. So the actual physical inventory would be there, but until it was recorded as being returned on system, it would mean our closing balance within the system would be too low. So that could be a possible reason. Moving on to part 2 then, complete the following statement. If the closing inventory reported was too high, this could lead to the gross profit being, and we need to select from either overstated or understated, and the current assets being overstated or understated. So think about your cost of sales calculation. During that calculation, closing inventory is taken off. So the basic calculation is opening inventory plus purchases less closing inventory. So if your closing inventory was too high, that would mean that your cost of sales was too low because it's deducted as part of that calculation. So if your cost of sales is too low, that would mean that your gross profit would be overstated. Similarly, if your closing inventory was reported too high, the current assets, considering closing inventory forms part of your current assets, this would also be overstated. Often one in an exam that you might need to just think through in your head, that one. Take a couple of minutes on it. It's only worth 2 marks, but take a couple of minutes if you do get one similar to that to just think it through as part of that cost of sales process. Moving on then, it says you are preparing the accounts for a sole trader and have been given the following information for the year ended the 30th of June 2018. So we've got sales including VAT was £76,080. Your client uses a gross profit margin of 30%. Purchases excluding VAT for the year were £48,390. And the inventory as at the 1st of July 2017, so this will be your opening inventory, was £5,050. Part B then, calculate the value of the sales net of VAT. So we're starting off nice and easy. So we should all be able to do this now. I appreciate everyone may have a different method for this, but the sort of textbook way of calculating it would be to divide your sales including VAT by 120 and multiply by 100. However, if you have your own method, keep using it, that's absolutely fine. But that would give you a sales figure net of VAT of 63,400. Now, to calculate the cost of sales, it states that gross profit margin was 30%. So if you've got your sales figure now of 63,400, what we're saying is that 30% of that figure is profit and 70% will relate to your cost of sales. So to get your cost of sales figure, it would simply be 63,400 multiplied by 70%. Which gives you a cost of sales figure of 44,380. And then the last step is to calculate your inventory as at the 30th of June 2018. So effectively calculate your closing inventory. So we do this with a mini reconciliation. Now that we've got all the other figures, we can use that to find out our closing inventory. I'll just remind you again, the cost of sales calculation is opening inventory plus purchases less closing inventory equals cost of sales. So if we've got opening inventory of 5,050, we've got purchases of 48,390, and we minus off our closing inventory, which we don't know, but that will equal our cost of sales for the year of 44,380. So our missing figure is our closing inventory figure. So all you need to do is add up your opening inventory and your purchases and then do the difference between those two added together and your cost of sales figure, and that will give you your missing closing inventory figure. So if we calculate that, that gives us a closing inventory figure of £9,060. Right then, the last question. Another client, Melissa Rose, sells dolls for £48 and has previously purchased the dolls for £40 each. She is not registered for VAT. Part C then, for 1 mark, complete the following statement. This means she has A, and we've got to select between markup and margin of 20%. So there will be those out there who can probably recognize straight away whether that's going to be markup or margin, because markup is calculated based upon your cost, margin is calculated based upon your sales. So what I would usually do here is start from markup. If it's not markup, you know it's margin. If you feel more comfortable with margin, you're welcome to do it that way. It just tends to be that markup is generally slightly easier to calculate, although it's negligible. So what I would do is check whether it's markup first. So we know that the profit is £8, because that would be your difference between your selling price of 48 and your cost of 40. So we know that profit is £8. So to check whether this is markup, we would do 20% of the cost. And if that is £8, then we know that it's markup. If it's not, then we know that it's margin. Obviously, you're welcome to check that by doing 20% of the sale price. However, I'm guessing that most of you can see that this is going to be markup, because we can see that £40 times 20% is going to be £8, which is your profit amount. So it would be markup. If we were to do margin, i.e. 20% of the selling price of 48, that would actually give us a profit of £9.60, which we can see it's not £9.60 because it's £8. Okay, brilliant. And that does actually wrap up this mock run through. I know it is a particularly tricky exam. Just from feedback that's been received so far, we do appreciate this is a difficult exam. I hope this run through has helped, and remember, if it has, hit that like button and subscribe to the channel for more AAT videos. If you do have any questions, obviously drop them in the comments below and I will pick them up as soon as I can. But best of luck with your exam if it is coming up soon. Keep revising. It's tough, but you will get there. It's just practice. And again, thank you for watching. I'll catch you in the next one.